Hello and welcome back to Pay Down Debt Solutions. I'm Jen, and on this channel, we teach velocity banking. We teach a style of banking that allows you to get out of debt faster and much more efficient than what the traditional banking system has you in. So we are not all things to all people on this channel. We just teach velocity banking and we just teach you how to get out of debt in a manner that will have you doing so much quicker than what you are accustomed to. So without further ado, let's talk today a little bit about your home as an untapped resource, right? As an untapped resource. So your house may be the line you were looking for. So when we teach velocity banking, the first thing we talk about is using lines of credit. Lines of credit will help you pay down debt much faster than the traditional system you're in. We say on this channel, always a line, never a loan. And we say that because lines of credit based on an average daily balance are what allow you to put your income in and run expenses out, which will then drop your interest rate and help you get out of your debt faster. So this is a really unconventional, different way of thinking. And we had a student today that we've been working with her, and she was, finding herself behind due to a situation in her life where a parent had passed, and so she had to use her resources to pay for funeral expenses. And so she was looking for a line of credit to help her get out of debt. Well, what happened is she ended up getting approved for a home equity line of credit, which is excellent. But when she went back to the banker was going to do her a favor and was going to turn that into a loan for her because she would get a 4% interest rate versus a 7 point something percent interest rate. And so she called us up wondering if that is something that she should do. Now, the way that we teach velocity banking, and those of you that have been following the channel understand that a loan is never going to help you get out of debt. A loan is based on an amortized schedule, and that amortized schedule does not allow you to put money into it and then turn around and take it back if you need to. So why might you want to do that? Why might that make a difference? Well, when you use lines of credit to pay off your debt, okay, what you're doing is you're putting your money into that line of credit and you're dropping. So you're putting your income into the line of credit, you're dropping the balance, and then that means you're dropping the interest rate that you would be, not the rate, but you're dropping the interest that you would pay. So when you drop the interest that you would pay, then you're allowing yourself to continue to pay less month over month over month, okay? So when you put your income into a line of credit and you have the ability to pay your expenses out, that means that all of your available income, and you will be freeing up available income, because if you look at this student scenario here, if she takes and puts this money into a line of credit, then what she'll be able to do is put all of her income into it, and all of these payments that she would be paying are free now. They're free to her and they come back to her as cash flow. And that cash flow is then what works down your debt. When you are in traditional banking and you look at all the loans that you have out there, you don't have the ability to put your income into them and to work your expenses out, okay? So you're stuck in this system, right? And you're on this hamster wheel of making payments, and it is those payments that cause you to be cash poor, right? And that's exactly what we are, you guys. Again, it doesn't matter to me what your income level is, right? It could be $2,000 a month, it could be $32,000 a month. It doesn't matter because we all find ourselves in the same position with payments. And it's those payments that are holding you back and keeping you from wealth building. Again, we don't teach wealth building on this channel, but we can get you there much faster, right? We can get you there faster by using lines of credit to work down your debt. So today, in this student scenario, we're going to be talking specifically about using a home equity line of credit. Now, this is not the same person as the one I was talking to who went to her bank and her bank said, okay, well, we're going to then do you a favor and turn that line of credit into a loan. Because it isn't doing her a favor at all now, is it? But what it does do is it lines that banker's pocket, because I'll tell you what, they make a whole lot more off of loans than they do off of those lines of credit. So I can't say for sure if he's padding his pocket. I don't know that. But his line of reasoning was, it's going to be a better interest rate for you. So overall, this is a better deal for you to go ahead and get that loan. But what he doesn't understand is how we do velocity banking and why you would want that available line of credit to you. Because that line of credit is purchasing power. It gives you power down the road for any purchase that you might need to make, or any incidental that comes up, or any emergency that comes up. It gives you a place to go. So the line of credit is more powerful to us than a loan every day of the week. So let's get into why we might want to use our house, okay, our house equity, as a tool to work down our banking. Now, you know, if you own a home, you know that you have something called equity. And what equity is the amount of resources. It's like a line to you. Okay, so your home is valued at a certain amount. Okay, and so your loan may be at a lower amount, and the lower that amount of that loan means that the excess between the value of that home and what your loan is at, this interim here, is cash to you. It's like cash, okay? It's untapped cash. And that's what we call equity. It is equity in your home. It is purchasing power. And so many people are sitting on purchasing power, okay? So the difference between the value of their home again and the amount of their loan, okay? So they're sitting on this, purchasing power or this equity, doing nothing with it. And they're sitting in these high debts, okay? Look at 9.8%, 4.7%, 8.2%, 9.6%, 25%, and 8.9%. Those are high interest rates, right? And so if you have the ability to use your equity, to use that cash flow that's sitting there, then by all means, I say do it, because this is what's going to get you out of your debts faster and get you on to that wealth building. Okay, so a home equity line of credit, again, is a line of credit that uses your equity to back it, okay? And so what it does for you is it offers you a low interest rate. And the reason that interest rate is so low is because it's backed by something tangible. Credit cards are not backed by anything tangible. They are backed by nothing other than your name, right? Who you are, what your credit worthiness is, if you're able to pay your bills, okay? So that's a risk for any bank or any financial institution to take on, because there's nothing to back it. They can't go and get something for the amount of money that you spent on that card, right? They can't take anything from you because there's nothing to take. But your home on the other end of the spectrum, I should say, is backed by something, the actual home itself, right? So a line of credit such as that is backed by your home, if the bank had to at some point go to get an asset from you, they could then have the home as their asset, okay? So that's exactly why those rates are lower, because there's something that backs it. You could go to a bank and get a loan, and sometimes they're backed by, let's say, a car, right? So you could secure a loan using your car. You could secure a loan using maybe a CD that you have, okay? So those are all asset backed. So a line of credit that's backed by your home is an asset backed loan, and that's why the interest rates are lower. So it also uses, obviously, the hidden cash flow that is in your home to help you pay off debt to make purchases, right? So like I said, those emergency purchases. So I have a student here, and they were looking to consolidate some of their debt, right? So they had a bunch of debt, and they had learned a little bit about velocity banking, and so they wanted a little bit of help with it. So they came to us, and we didn't do a whole lot for them because they kind of understood what was going on, but we did offer them some pointers. So let's talk about the situation that they have and how home equity lines of credit can help you. So in their scenario, they have an income of $6,890. Their total expenses are $6,610, which leaves them $280 worth of cash flow. So that's the cash flow that they have. Now, they had a home equity to begin with. They had a home equity line. There was $22,000 on it, $22,141 to be exact. But that line amount, the limit is $84,000, okay? So here they have a mortgage, and this mortgage they have been in for 19 years. So remember, those of you that recall when I talked to you guys about mortgages and about amortized loans, the most advantageous point in you paying down a mortgage is obviously in the beginning, because those amortized schedules allow the interest, or I should say they have the interest, the most interest that you're going to pay at the top end of that loan, at the beginning of the loan. And then as that loan goes on, you pay less and less interest, okay? And so you're paying more in interest and less in principal when you first start a mortgage. And then over time, that reverses, right? You're paying less in interest and more in principal, okay? And so that is what an amortized loan is. So you are better off if you're going to put down a chunk of money, you're better off and you will save more if you put a chunk in the beginning of that mortgage. Okay, so you're going to save more than you are at the end. So here they are, they've been in there 19 years, which means they are paying a lot less in interest than they did in the first, let's say 10 years of the loan. Okay, so their home is valued right now, or I'm sorry, the balance on the mortgage is 123,382, and their loan is at a 6.85%. And they had considered over the years refinancing, but they never did that. Okay, but they did, however, get this home equity line of credit. And so that home equity line is sitting at 22,141. Again, the limit is 84,000. They have an interest only payment that they're making for 182 a month. Okay, so interest only. Now, their mortgage amount, and I kind of squeezed that in there, it's 1,392 is what they're paying each month for that mortgage payment. All right. Now, let's back up to the home equity line again. The line itself is at a 9.8%. Now, add interest only. If they are going to continue to pay 182 on a $22,000 loan, it's going to take them 55 years and it would cost them $99,221 in interest. Okay. So we don't want to do that, right? That's not something we want to do. We don't want to get a home equity line of credit and then just pay the minimum payments on that. We want to do our best to pay it down faster, which is where Velocity Banking comes in. Okay. So again, 55 years at 99,221. They have a car out there. That car loan is currently at 9,827. The payment on that is 675, and it is at a 4.7% interest rate. It has 15 months left on it. Okay, and so 15 months and $346 left to pay in interest. So this loan originally, I think, let me see, I have it written down here. It was, I think it was 29,000 something. Okay, I wrote it down. I don't know what I did with it. Sorry, I think it was 29,000 though. So this has been this has 15 months left on it. All right, so there's not a whole lot of interest left. So one of the questions they had was, should they roll in this car into this home equity line of credit? Okay, so that was a question, and we're going to solve that for you. We're going to actually show you what, whether or not they should do that, right? Because when you put this car loan in, obviously the balance is going to be higher that you're working down. So do they do that or not? Well, we'll work that out. So car number 2 here is at 18,641. It's 354. They just got this, and it's at 8.2%. It is a 5-year loan, and the payback on that is $3,287. So they would pay $3,287 in interest to term that out. Now, they have a SoFi loan. Okay, so that's like a personal loan, and that is $13,680. They have $344 as a monthly payment, and that is at a 9.6%. It's for 4 years, and they would pay back $2,848. They have a Truist credit card. It is at the balance is $4,982. $154 is their payment, 25% interest, 4.7 years to pay that back at interest in 1%. And that is the interest that they'll pay is $3,407 on that. And then they have another personal loan here. It's for $4,310. Its payment is $107. It's at an 8.9%, 4 years. And to pay that back, the interest would be $828. Now, when you take a look at their overall picture, they have 280, which is not a ton of cash flow. Okay, so that's probably why they did some of these things, like the SoFi loan and the personal loan. I'm not sure exactly why they didn't put it on the home equity, but that's a conversation for another time. Okay, so when we look at their debts here, if they were to term these out, we know that it would be $1,009, or I'm sorry, $109,937 to pay that off. And of course, the longest term is 55 years. So we don't want to do that, obviously, right? We don't want to do that. We want to find a better way. And so that's exactly why they came to us, was to find a better way to do this. And they were pretty much on track, because after learning Velocity Banking and starting to understand it, they knew that they wanted to take these debts and roll them into this home equity and then put all of their income in and pay their expenses out like we teach, right? So if they do that, what does this look like? Okay, and the question is, do we take this car payment that has $9,000 left on it, And do we roll it in? It only has $346 of interest left to pay. So that was one of the questions. So we're going to run it first, including it in our line of credit. So here's what that's going to look like. So when you start Velocity Banking, we know that we're going to start with our loan, okay? So as we add these all up, right? There, it's 73,581. So that's what we start with, right? So 73,581. Okay, so we start here and we know that we're putting our income into it, right? And so what's our income? Our income is here. It's at 6890. So if we subtract 6890, because we're going to put all of our income into this, and why can we put all of our income in? Why can we do that? Because we know that when we have home equity lines of credit, most of them are attached to a checking account, okay? And so when they're attached to a checking account, that means that you can run all of your expenses out of that checking account and they will pull from that line of credit to cover those charges. All right. So you have to make sure that it's set up that way before you just assume it, right? You don't ever want to assume that. You want to make sure it's set up that way. So it'll pull as an overdraft line, and theirs will. Some of them don't pull as an overdraft line. You have to manually move the money. Okay. So sometimes you have to do that. But in this case, it is set up as like an overdraft line. Okay. And so we're going to go ahead and we're going to start this. So when we put our income in, all right, so we have 73,581, right? And then we're going to subtract our 6890, which gives us 66,691. Hopefully I've done my math right here. 66. So 66,691. All right. And I will just double check that because I have been known to fat finger things. So 73,581. 73,581 minus our 6890 equals 66,691. Okay, so that's good. All right, so 66,691. Okay, so what's our next step? So now we've put in our income. So what happens next? Well, we have expenses, right? We have expenses, and we also have interest from this line of credit. So here's our line of credit, but we know it's at 9.8%. So we have to figure out what our interest is going to be every month so we don't have any surprises and we can make sure that we are running in the right direction, right? Okay, so if we've rolled in all of these debts here, okay, so what we're going to do and how do we figure that? So here's how we do it. We start with our total expenses, so 6610, and we're going to subtract all of the things that we have rolled into this line of credit. So 6610 minus, okay, so we're going to subtract out our 182. We're going to subtract out our 675. We're going to subtract out our 354. We're going to subtract out our 344 and our 154 and our 107, which leaves us with 4794. So 4794, and I'll double check that on my other sheet here. Yep, 4794. Okay, so that 4794 is what our expenses are. But we have to add these in, right? 4794, right? 4794. Yeah, so we have to add these in. Why do we have to add them in? Well, because they're expenses, right? And we're running those expenses out of that line. So these have to come back in. We have dropped our balance by putting our income in to 66,691. But we also have expenses that are going to come out, so they're going to be added back into this line. But now we have to figure out what our interest is, okay? Because that's going to still be charged to us. So we take our little green marker here and we figure out what our interest is. Okay, so we take our high balance. All right, so to figure out our interest, we know our interest rate is 9.8%. We have to take our high balance and we have to add it to our low balance. Okay, so we're going to take our 73,581 and we're going to add it to 66,691. And that gives us 140,272, which we then divide by 2 to get our average, which is 70,136. Okay, so we have our average now. And then we have to take that average and multiply it by our interest rate. Okay, so I'm going to multiply that by 0.098, and that equals 6873. And that number then is for a year's worth of interest. So I now have to divide it by 12 to give me the interest I'm going to pay on this for the month, which is 572. All right, so 572 is the interest that I'm going to be paying. So 572 is my interest. All right. So this is the start, right? So I'm going to add this all up now. So I have 66,691. And so now my expenses are coming back into this line of credit because I have to buy groceries and gas and all my living expenses. All of my expenses are coming out, right? So there are my expenses. And then I have my interest rate here, right? So I'm going to take my 66,691 and I'm going to add my 47.94 plus my 572, which equals 72,057. So 72,057. And I'm going to double check that. So 66,691 plus 47.94 plus 572 equals 72,057. So now I have to do some checks here, right? I have to make sure that I am not going in the wrong direction. I have to make sure that my plan is working, right? Because this is a hefty amount of interest, right? That's 572 is a lot of interest to pay. So I have to make sure that the interest isn't overtaking me and that I'm going in the wrong direction, right? Or that I'm not expensing too much. So I take and I look at this. I say, okay, I started with 73,581. I put my income in. It dropped me to 66,691. My expenses are coming out. Remember, my expenses minus all of these here, right? All of these things that I am now, that I've rolled, okay, into this loan. So I have 4794, okay, and I added the 572, which means that I'm at 72,057. So 72,057, is that higher or lower than the 73,581? Well, it's lower. So we know that our plan is working and that we're going in the right direction, okay? So now we're going to come into month 2. So it's going to be more of the same, right? I'm going to do the exact same thing. I am going to bring my income in. So my income is going to come in. My income is the 6890. So I subtract out the 6890, right? And then I get my starting for the month, right? So the 72. So 72,057 minus 6. Whoops. Got to redo that. So 72,057 minus 6890 equals 65,167. So 65,167. Okay. Now, remember, my expenses are going to be the same because nothing's changed, right? I still rolled everything in here. So nothing else has changed. So I have to add in my 47.94. Okay. So I'm adding that back in. And now again, I have to calculate my interest, right? So I have to calculate my interest. So I've got 72,057 plus my 65,167 equals 137,224. Okay. Divide that by 2 equals 68,612. And I multiply that by 0.98 equals 6723. And that I then divide by 12, which gives me 560. Okay, so 560. So here I go with my 560. Add that back in. And let's calculate this up and make sure that we're going in the right direction, right? So 560, okay, so 65,167 plus 4794 plus 560 equals 7521. Okay, now I'm at the end of this, right? I'm at 70,521. I check it. Am I greater or less than the 72,057? Well, the 7521 is less than the 72,057. I'm going in the right direction, which means my strategy is working. So how long then does this take for them to start with the 73,581, taking all of their debts here and rolling them into this home equity line of credit, right? Getting back this payment, getting back this payment, getting back this payment, and this payment, and this payment, and this payment, right? So all of these payments then come back to them because they're rolled into that line of credit. And because I'm putting more income into that line of credit, I'm satisfying what would have been this payment, right? I'm satisfying that payment so I don't, quote unquote, owe it. it then comes back and helps work down my balances as cash flow. All right. So if we rolled in the $73,581, okay, we would spend, it would take us 38 months. Okay. So 38 months. Can't take my pen off. So 38 months, and which is what, 3.1 years or so, 3.1 years. And we would spend 12,077 in interest. Okay. So this is what we would pay in interest over 3.1 years. Now, on the flip side of that, it was going to take at the longest 55 years, and it was going to cost $109,937. All right. Which would you choose? Right. So this is why we teach this to you guys. This is why we show you a different way to do your banking than the traditional system. Traditional banking holds you down and keeps you making payments and enriches the banks and keeps you guys poor, right? So we do something different. We do velocity banking. Now, again, in speaking of, wealth building, right? You can spend 3.1 years destroying your debt and be building wealth, getting rid of all of this. So now you'll have cash flow to do something with it, to invest, to do whatever you guys want with at that point, right? So 3 years to get rid of $73,581 in debt. Now, their question was, what if we left this car loan out because we only had 15 months left on it, and it's only going to cost $346 in interest? So should they do that? That is the question, okay? So let's run that. Let's take it, all right? So let's take that and let's run it. Let's erase this. Okay, we'll leave the 38 months there so you guys can see that. Okay, so we're going to erase this. And so if we do that, we're going to start with, well, if we subtract off our, what is that? Our 7358 minus our 9827 should be 63,754. So 63,754. All right. Anybody want to take bets? Is it going to be more or less to do this? What do you think? Well, it's less that we owe overall, isn't it? It's less than we owe overall. So that is a good thing, right? It's less. Knowing we're only going to pay $346 in interest after 15 months, right? And there's $98.27. But when we talk about getting payments back, right, that's an important thing. And this is a pretty steep payment because this loan started out as a whole heck of a lot more. So we have $675 that in 15 months worth of time was going to work for us in the other scenario, wasn't it? So what happens if we don't include this payment? How long does it take, right? How long does it take? Well, we still have the same amount of income that goes in, right? So it's the 6890. So 6890. All right, so we're subtracting that off. All right, so we subtract that off and we get, what do we get? All right, so if we take our 6390, we take our 63,754 minus the 6890 equals 56,864. So 56,864, right? Okay. And then what are our expenses going to be? Okay. So we have different expenses now, right? Because if we leave this in, what will the expenses be? So we take our 6610, we subtract off our 182, we subtract off our 354, and we subtract our 344, we subtract our 154, and we subtract our 107. So that's 5469 would be our expenses, okay? So 5469, where's my expense color? So minus 5469. So these expenses are more. And what is our interest then? Okay, so we have to figure out our interest. All right, so if we take our 56,864 and we add our 63,754, that's going to equal 120, what is that? I can't read backwards, 126.18. And then we divide that by 2, and that's going to be 60,309. And then we take that and we multiply by 0.098, which equals 5910. And then we take that and we divide it by 12, and that's going to be 492. Okay, so 492. And let's see if that is right here. Yes, 492. So 492. Okay, and I already ran this with Dan's handy dandy work here, his app that he created. Okay. All right, so we're going to add that together, and what do we get? So we take our 56, 864 minus 5469. Whoops, not minus, that's plus. Sorry, guys. So 56, 864 plus 5469 plus 492 equals 62825. So 62825. Okay, so in running our checks, are we going in the right direction or the wrong direction? Well, we are going in the right direction, right? Because we started off with 63, we dropped it to the 56, our expenses and our interest come back into the line, and we come back up to 62,825. So this is less than this. So we are going in the right direction. But how long does it take to do this? Well, the answer might surprise you. It actually takes us 50 months, okay, so that's 4.1 years, and we spend in that 50 months 13,966. Okay, so that's 13,966. But we are not done, right? Because in 15 months worth of time, we still have to add this 346 to that number. Okay, so we have to add our 346. So what is this? 11, 9. So 13. So we spent, what is that? 14,312 if I've done my math wrong, right? All right. So even though we have less that we are putting into this, right? So we are putting less money into that line of credit to begin with. What happens is this payment is that important to us because that payment works down our debt much faster than it is holding it out. Because remember, this is running for 50 months, right? So at the 15-month mark, okay, we would have been getting back the 675. But here, it didn't matter because it took us so long. We couldn't overcome the 675, right? We needed that money to begin with. And so even though we added 9,000 to the original amount that we started with, it made more sense in this case to bring that loan into the numbers because of this payment. All right. Now, if this payment was a lot smaller than that, it might have worked out in the opposite, might have worked out differently. But because that payment is so large, we needed it to get our loan taken care of faster. But this is the fun stuff of velocity banking, you guys, because you get to take numbers and you get to play with them and you get to see what will work out better for you. And even though we took on more debt, it ended up working out much faster for us and with less interest spent over time. Now, it's not a ton less, right? It's a couple $1,000s less, but it's still less in time, right? And that time is what matters too, because remember, you're wealth building after that. After 3.1 years, you're starting to build wealth earlier than you would have, had you run it this way. So why do we do velocity banking? It's written right there for you. I hope you guys learned something today. If you have any questions, feel free to comment below the video. We are always here for you. We're always working for you, and have an amazing day.